So Kavita, you have to have your asset allocation correct. Now, like you asked me, how do you choose or what do you do? Firstly, you have to see the market cap of what you buy. The market cap is the best guide of where your risk reward is. As Warren Buffett said, he said there is a price for everything. And when the price is in my favor, then you go whole hog in what you want to invest in. Now, in some of the mid caps, we've seen that a lot of the price erosion or the price performance was more to do with greed and fear, and we think that mid caps are offering a very good entry point. Plus you are playing against the large cap index, which trades at a very high multiple, in the sense, in the emerging market basket, and which seems fairly priced or fairly expensive. So mid caps offer you that value, and that is why you have to go deeper into what you buy, as in the market cap, the promoters, the peer group, the debt, how the cash is utilized, and last but not least, how the peer groups are performing. And in that, you select your basket of stocks which you think have a potential to become from mid to slightly larger and large caps over the next few years.
Sanjeev, just like how we plan our entry in the market, although one should not time the market, but if we leave the entry part aside, how can we time the exit in a particular stock, and how important it is?
Yeah, that's a very good point. Now that again depends on your horizon, your risk profile, and your return, expectations. So Kavita, the first thing I must tell investors is trust your mutual fund or trust your relationship manager. I am in a broking firm, so obviously this is our job. Whether it is depending on the amount of corpus you have, whether it is direct investment through equity mutual funds, through PMS, through AIF. There is a whole basket of investments. Now you have to plan your investments in how you want to generate returns and what is your goal. If you have a goal, only then will you be able to achieve your desired objectives. After being in the market for 33, 34 years, I realized the first thing you start off is, because capital is limited, you try and generate a return in your mind which gives you a certain amount of uh, what you expect. Once you generate that return, what I started to do was, since my capital was limited, I took out my capital, but I let the profit remain in the shape of those stocks as an investment. And some of those actually worked wonders, and those investments grew. So to each person is dependent his own style of investing, his expected returns, and when he wants to take home the profit. But periodically, if you are not there for the next 5, 10, 15 years, which is an easy way to say, then when you see that the market is looking frothy, it is always advisable to take home some cash and wait for another rainy day when again you can deploy that.
All right, when we talk about investments, we really try not to strategize our portfolio strategies or our portfolio calls based on near-term events. But then, since you are there with us, I want to understand your take on the RBI policy on the 8th, and also next week the Fed policy. What do you think can be the call taken? The rate pause will be extended, and looking at the global triggers now, how strong are we on our grounds?
So, Kavita, firstly, let me put it on record. Unfortunately or fortunately, the Fed lost credibility. In 21, when inflation was starting to rise, he termed it as being transitory and misread the markets. And then you came all guns blazing when inflation hit sky high at 9.5%, and you raised rates from 0.5 to 5% in the space of 8 months. Then you had your casualties, the SVB Bank, the First Republic Bank, in Europe, Credit Suisse. So all these are short-term measures which created panic as far as the currency, and some of the leveraged banks which misread the market on the interest rate scenarios in the short and the medium term.